Okay. Good morning, everyone. Welcome to our second batch on second session on Ind AS 113, that is fair value measurement. So in the previous class, we had discussed an introduction to this standard, why this standard had to be brought about, because there is a fair value requirement at every stage in the Ind AS regime. Okay, so take Ind AS 109, Ind AS 19, okay, Ind AS 40, Ind AS 16. All these standards prescribe fair valuation at different points of time. So for that reason, the standard setters felt that we will incorporate fair values measurement in a different standard altogether, so as to minimize the the quantity of the literature that is published. So that is the reason we have Ind AS 113. So when we started off, we discussed first what do we exactly mean by fair value. And fair value, we saw the very comprehensive definition. So fair value ultimately is nothing but it is an exit price. The price to sell an asset, the price received to sell an asset, or paid to transfer a liability. This was the thing that we saw, which means that it implies that it is an exit price. So price received to sell an asset or paid to transfer a liability in a transaction between whom? In a transaction between market participants. So who are my market participants? Any player in the market. Important point is it does not mean related parties, although related parties are covered if you have transacted with them at an arm's length price. So price related to selling an asset or paid to transfer a liability in a transaction between market participants in an appropriate market in an orderly transaction at the measurement date. So this was the definition that we saw. We understood who are market participants, and then we moved on to have a look at what is the meaning of an appropriate market. There are two types of markets Ind AS 113 discusses about. The first one is the principal market. That is the market where there are largest number of buyers, largest number of sellers, highest number of transactions, thereby implying that your values ultimately converge to a fair value. When I say converge, it happens so because there is a great deal of awareness between the buyer and the seller about the product that is being transacted with. Okay, and therefore you are going to have a fair value convergence ultimately. However, when we move on, it is we also saw that it is similar to the perfect competition market that we had discussed, that we had studied in our economics. No single buyer or seller can influence the market independently, and that is why perfect competition is the best form of markets. And here also we have enshrined a similar concept. If there is a principal market, we will not look at any other market. Our fair value will be based on the price that is there in the principal market. Let us move on to the next one. Suppose there is no principal market. Then we look to something known as the most advantageous market. What do we mean by most advantageous market? That market which maximizes the net proceeds is known as the most advantageous market. Sir, what do you mean by net proceeds? Well, net proceeds is nothing but whatever is the available price in the market minus the transportation costs minus the transaction costs. Sir, what do you mean by transportation costs? Cost to make the asset available in the market. Cost to make the particular asset available in the market. What do you mean available? Well, for instance, we use the term transportation because it is easy to understand. Okay, transportation means you are making an asset available in the market. It could also mean costs of completing a work in progress item, because then you are making it available for sale. So transportation cost need not necessarily be related to the movement of goods. It can also mean any cost which alters the goods, which alters the product in question so as to make it ready for being available in the appropriate market, the most advantageous market in this case. So we will be deducting the transportation costs and then we will also be deducting the transaction costs. Why do we deduct the transaction costs? Because it is specific to a transaction. It is ultimately going to affect my net proceeds, and therefore when we deduct the transportation costs, when we deduct the transaction costs, we are left with the net proceeds. We will look at in which market my net proceeds are maximized, and the market where the net proceeds are maximum, that market ultimately is going to be my most advantageous market. I will then pick up the available price in that market. I will pick up the transportation cost for that market, and then I will deduct the transportation cost from the available price to determine the fair value. Transaction costs are ignored. Why are they ignored? Because it is a transaction specific cost. It is not an asset specific cost. We studied in fair valuation that asset specific costs are to be considered. Entity specific restrictions, entity specific disadvantages are not to be considered because they pertain to an entity and not to a market participant as such. That is why transaction costs are ignored. So available price minus the transportation cost is going to be your fair value, and fair value minus the transaction cost is going to be your net proceeds. Okay, so this was what we had discussed in the previous session. Then we moved on to uh, one or two practical questions we saw, and then we moved on to valuation of non-financial assets. So what do you mean by non-financial assets? Well, non-financial assets essentially means your assets which are what you can say other than financial assets. Financial assets specifically refers to the assets which are going to give you source of income like interest, dividends, capital appreciation, etc. Okay, so these are what you mean by financial assets. There the source of income is fairly simple and clear. So the valuation, we know in which direction to proceed. However, when we talk about non-financial assets, there are multiple uses possible, and we determine the multiple use from which particular source. We determine from the source or from the perspective of the market participant. So if you hold a land, there are multiple uses that you have with the land. Okay, so what do you mean by multiple sources? There are multiple uses. The first one, you could keep it idle. You could keep it idle, or you can use it for a parking lot, or you can use it for construction of a residential complex, commercial complex, hybrid complex, leisure park, you name it, parking lot, you name it, and the uses are there for you. Okay, so therefore at this point of time it becomes quite difficult for us to understand what is the highest and best use. So the standard has given basically two guidelines. The first one is you will look at all the possibilities, but you will only think of those possibilities which meet three conditions. That is it physically possible? Is it legally permissible? Is that particular option financially feasible? You have a plot of land. Okay, that plot of land can be even used to build a space, what you can say, a space launch facility. But is it physically possible? If this plot of land is in the middle of the city, do you think you can have a space launch facility there? No, it's not physically possible. So you cannot just think of any option and move about. Okay, it should meet all the three criteria: physically possible, financially feasible, and last one is legally permissible. Once this is done, we determine which option is there, and basis that we determine the highest and best use. The second hint that the standard gives you is most of the cases the current use is the highest and best use. So that is the guidelines that the standard has prescribed. Okay, what you have to consider is, in case you are considering an alternative use, then you will have to deduct the estimated cost to be incurred. Okay, so that takes care of highest and best use. And then we were discussing valuation techniques, wherein we came across a golden rule. What is the golden rule? Maximize the use of observable inputs, minimize the use of unobservable inputs. And then I had requested you to just go through these 3 levels of inputs, which we shall now proceed to discuss. Okay, so this was a recap about what all we discussed in the last class. Good morning, Manini, Sandhya Gauri, Sumit, Soham, Srishti. Good morning. Okay, so I trust that last session was fairly clear to all of you. So let us now proceed with the inputs, and what do we mean by the meaning of this rule? Maximize the use of observable inputs, minimize the use of non-observable inputs. Okay, so let us start with this. Okay, suppose you are a company A Limited. You are a company A Limited. Okay. I'm just drawing a simple balance sheet. I know it's not as per T form, blah, blah, blah. Please don't yell at me. Okay. It's not vertical, etc. But I'm not here for discussing the format of the balance sheet. I'm here to make you understand. So on the asset side, you are having investments. In Maruti Suzuki Limited. Okay, so suppose A Limited is holding, let us assume 100 equity shares of Maruti Suzuki Limited, and it is the end of the year, and Ind AS 109 specifically tells us that Maruti Suzuki Limited, these are equity shares, they have to be fair valued. So you will have to determine the fair value of Maruti Suzuki Limited's shares. How are you going to determine? How are you going to determine? Sir, very simple. On 31st March, look at the price in the National Stock Exchange, and that price is going to be your fair value, because the maximum number of transactions happen in the National Stock Exchange. So therefore, very simple, I will pick up price as per National Stock Exchange. So suppose that price is rupees 9,000. Suppose that price is rupees 9,000. Therefore, fair value is equal to rupees 9,000 into 100 is equal to rupees 9 lakhs. Have you understood this part? Yes, fairly simple. Tell me one thing, friends. This valuation that we just now did, is it an objective valuation or is it a subjective valuation? Subjective का मतलब क्या है? Subjective means there is a lot of bias. There is a lot of estimation. There is a lot of assumptions. There is a lot of what you can say, calculations. Look at this valuation. Is there any assumption? Is there any presumption? Is there any estimate, or is it a straightforward valuation? What do you guys think? Is it a straightforward valuation, or is it one which involves a lot of estimates? Come on. So yes, Manini has responded. Good morning, Hari. Manini has said it is an objective valuation. More answers, please. What do you guys think? Srishti, Sandhya, Sumit, Soham. Straightforward valuation. Excellent. So most of you agree that this is a straightforward valuation, which it actually is. Okay. So this input, see, whenever I have to fair value something, I'm going to need inputs to arrive at the fair value. So what is my input in this case? Sir, my input is this figure, price as per NSE, price as per NSE. So price in the National Stock Exchange becomes your input. You just take that price, multiply it to your quantity and get the fair value. This is known as a level 1 input. This is known as a level 1 input. There is a market. That market is meeting the appropriate market criteria. You take the price as per that market and do the valuation. So this is what is going to be known as your level 1 input. This is what is going to be known as your level 1 input, straightforward valuation. So this is known as an observable input. This is also known as an observable input. What do you mean by observable input? भाई मैंने input देखा, मैंने input लिया और उस हिसाब से value किया. I took the input, I observed it, took it and valued my holding based on that without any adjustment. So this is meaning of maximizing the use of observable inputs. Maximizing the use of observable inputs. Let us move to the next case. I am also having an investment in Hyundai Private Limited. And here I am having another 100 equity shares. Here I am having another 100 equity shares. Now you tell me shares of Hyundai not listed. It's a private limited entity. The shares are not listed. So if the shares are not listed, can I go in for getting the market price from any recognized stock exchange? No, you cannot. So that point of time, we will have to use a valuation technique. What valuation technique will be used? Well, I know for one reason that both Hyundai as well as Maruti are in the same line of business. They are in the same line of business. And because they are in the same line of business, if I will have to fair value Hyundai, what can I do? Well, I can take the valuation as under price of comparable company, Maruti Suzuki. This is 9,000. This is 9,000. And then can I take straight away 9,000 and multiply it with 100? No, I cannot, because here this is going to be, this is not Maruti. So you cannot take 9,000 and multiply. You will have to do some adjustments. Add less adjustments. Sir, what adjustments could you make? Well, adjustments could be multiple. There is, for example, a liquidity discount. A liquidity discount. Sir, what do you mean by liquidity discount? It means that you are not going to be able to sell your shares in Hyundai as easily as the way you would be able to sell your shares in Maruti Suzuki. That is a big plus. Okay. Being able to trade freely in your equity shares is a very plus point. Because Hyundai is not freely traded in the stock exchange, you will have to give a liquidity discount. So that depends on a valuation model. Okay. So some may estimate it 3%, 5%, 10%, whatever it is. So there will be something known as a liquidity discount. Then there would be something like, what is your extent of holding in Hyundai? Are you holding 5%, 20%, any sizable chunk, or you are just a small shareholder? Okay. So adjustment for stakeholding. Okay. There would be some certain multiple of adjustments, and then you would get something known as a value. This value, let us assume, is 8,500. Okay. So now this becomes fair value of Hyundai Limited. fair value of Hyundai Limited. Now tell me, is the valuation of Hyundai straightforward? Is it highly subjective, or is it moderately subjective? What do you guys think now? Is it highly subjective? Is it completely objective, or is it somewhere in between? Is it somewhere in between? What do you think? Srishti, liquidity discount is not a transaction cost. Suppose you are holding shares of Hyundai and you come to me and tell, I want to buy the shares, I want to sell the shares of Hyundai, will you buy it? So when I have to buy the shares of Hyundai, I know for a fact that these shares are not traded on the market. You go to any third person X, Y, or Z to sell Hyundai shares, each of them knows that the shares are not liquid. That means they are not easily tradable in the market. And therefore, liquidity discount is not a transaction cost. It is an asset specific characteristic. It is an asset specific feature. That is why we will have to consider that. Okay. Is it okay? All right. So great. So Sumit, Manini, Soham, all of you are saying that it's moderately subjective, which is the right way of understanding. Okay. So suppose, what do you mean by moderately subjective? Sir, we take the price of a comparable company, we do some adjustments to that, and we determine the fair value. Another example, investment in gold, 100 grams. Sir, which gold? 20 carat gold. 20 carat gold. Okay. You are having ready-made prices of 24 carat gold available in the market. You are having the prices of 22 carat gold available in the market. But you will not be having the price of a 20 carat gold. So suppose a 24 carat gold is worth rupees 6,000. So 20 carat gold ka price will be how much? 6,000 divided by 24 into 20. 6,000 divided by 24 into 20. So that comes to how much? 5,000. So you will value this as 5,000 into 100 grams. So that comes to 5 lakh rupees. Again, I start off with an input that is observable. I do an adjustment to arrive at the fair value. So taking observable inputs and doing the adjustment to that, this classifies as a level 2 inputs. This becomes level 2 input. It is not totally objective. जैसे मारुति का वैल्यूएशन किया, जैसे 24 कैरेट वैल्यूएशन का होगा. It is not a totally objective valuation, but it is not completely subjective. Sir, can you give an example of completely subjective? Yes. Okay. So suppose you are holding shares in which one can we take? Okay, you are holding shares in any company. Okay, so there are so many space launching companies, I mean space vehicles launching companies that are present right now. So we take one of them. Okay, there is this company called as Agnikul Cosmos Private Limited. Okay, This is currently based out of IIT Chennai, IIT Madras. Okay. So you are having shares in Agnikul Cosmos Private Limited. Okay. Or you can take shares in Cred. Okay. Any of these companies. Now, Agnikul is into space vehicles launching, space exploration, etc. Cred is moving to become a fintech company. So you are holding shares in these companies. Now, none of these entities have a comparable listed company on the market. None of these companies have a comparable listed company on the market. So if they do not have a comparable listed company, भाई हम valuation कैसे करेंगे? How do I do a fair valuation? That time we can do a fair valuation using a discounted cash flow method, But if I have to do the discounted cash flow method, how am I going to do it? Well, you are going to do it using estimates of future cash flows. You would have studied this in SFM. Estimate of terminal value, determination of discount rate. Discount rate is having two things. One is cost of equity. Another one is growth rate. Cost of equity can be determined as weighted average cost of capital, or you can use the capital asset pricing model, jahan pe you will be having the usage of beta. Beta is nothing but the variation with the returns with the market. Again, no comparable beta available because your company is unique. No comparable beta. So again, estimate the beta. Growth rate is a total estimate. What is your growth rate in the first year, second year, third year, fourth year, fifth year, and thereafter, once the company stabilizes, what is going to be your growth rate? So all these are estimates. Okay, all these are estimates. Can you tell me now, this valuation, discounted cash flow, tell me, is it objective? Is it moderately subjective, or is it highly subjective? Is it highly subjective? Is it highly subjective? Come on, guys. What do you think? Is it objective? Is it highly subjective, or is it somewhere in between? What do you guys think? Come on, Soham, Sumit. Today Balram is not there. Sandhya. Yes, Srishti, Soham, Manini, Sumit. Aniket Jain is not there. Hari. Come on, punch in your answers. Highly. Hari is saying, Srishti, Soham, these guys are saying it is highly subjective, which is actually so. Every step, there is an assumption. Every step, there is an estimate. Every step, there is a presumption. Every step, you can question, ऐसा क्यों किया, वैसा क्यों नहीं किया? That is the kind of thing that you are having. So this becomes a highly subjective valuation, highly subjective. And therefore, this category, we call it as level 3 inputs. Level 3 inputs. Level 3 inputs. Okay. Level 3 inputs. Yes, Jay Srivastav, 20 karat gold valuation is going under level 2, whereas this DCF will go under level 3. Aniket Jain, ये in between नहीं है, मैं कुछ देख ही नहीं रहा हूं. I'm not seeing anything comparable here. Everything I'm estimating from the start. Okay, so it is a level 3 valuation, level 3 inputs, The growth rate is an input. The discount rate is an input. The cost of capital is an input. The WACC will be my input. The market risk-free rate will be available, but the risk premium will be a level 3 input. Basically, everything that goes in this valuation is going to be based on an estimate or an assumption. And therefore, these are known as level 3 inputs. Okay. So now I have valued it. Okay. Now, many of you are doing your audit or articleship, whatever it is. So now you tell me, out of all these three types of assets, 1, 2, 3, which is the most reliable? Which is the most reliable? Which is the most reliable? Sir, पूछने की बात है, Maruti is the most reliable because there are no assumptions there. Observable inputs. The next reliable one is Hyundai Private Limited. The next reliable one is Hyundai. Sir, I got a value. मैंने थोड़ा adjustment किया and then I arrive at the valuation for Hyundai. The least reliable is shares of a company like Agnikul Cosmos or Cred. Only and only adjustments are there. Only and only adjustments are there. Now let us come to your auditing standards. Suppose you go as the auditor of this company. Suppose you go, I'm just deviating a bit so that I can connect with you a little bit on the audit front. Suppose you go to do the audit. What is going to be very difficult for you? Sir, the valuation of Agnikul Cosmos is going to be very difficult. See, when you are the auditor, you are certifying the true and fair view of each of these items. Okay. So you will ultimately be required to express your opinion on the valuation of Agnikul Cosmos. Is it giving a true and fair view? And when you are going to express a view on the valuation of shares of Agnikul Cosmos or on the valuation of Cred, what are you going to certify? You will have to look at each and every assumption that is made. You will have to challenge the company which you are auditing, that why did you take this discounting cash flows? How did you arrive at the projections? Do you have any guaranteed book order standing? Or is it a industry average cash flows which you are taking? So give each and every estimate, question each and every estimate to determine at the fairness of the valuation of these shares, which is why we are having something known as SA 540. What is SA 540 dealing with? What is SA 540 dealing with? Auditing accounting estimates, including fair value estimates. So it becomes very crucial for us when we go to audit such companies that we will not only have to tick the values that are readily available, but we will have to also question where the values are determined basis the subjective valuation. We are not saying the company is doing something wrong. We are just saying that how the company determined this valuation. Is it okay? Yes. Is it fine? Have you understood clearly level 1, 2, and 3? Yes. Yes. Sumit Jain, these levels are defined in the standard itself. These levels are defined in the standard. Chalo, bolo. What do you guys think? Have you understood level 1, 2, and 3? Okay. So now when the standard tells you maximize the use of observable inputs, minimize the use of unobservable inputs, what do you mean by that? You mean that try to go for a level 1 input valuation as far as possible. See, Maruti Suzuki shares, I can do a DCF valuation also. I can do it. It requires estimation of Maruti's revenues in the future, growth in the future, WACC in the future. It requires the usage of capital asset pricing model, beta, whatever you name it, what is there in level 3, you can do the same valuation for Maruti Suzuki also. But why are we not doing it? Because the standard specifies clearly and rightly so that observable inputs, when they are available, please don't go anywhere else. Stick to the observable inputs. If observable inputs are not there, then you move on to level 2 and level 3. So the main criteria is maximize the use of observable inputs, minimize the use of unobservable inputs. Have you understood the rule, the inputs, and why this rule is framed? Yes, it is to promote true and fair view of the numbers that you are presenting in your financial statements. Okay, all clear? Yes. Srishti, Manini, Soham, Sumit, Aniket, Hari, what do you guys think? Sandhya, Kaushiki, yes. So all these are clear, sir. Clear, sir. Okay, great. So then let us now come back to our theory. Let us now come back to our theory. Okay. So I had told you to study, just go through it. Probably if you would have gone through, much of it may not have been very clear. For some of you, it may have been very clear. Okay. So objective of the valuation technique is to estimate the price at which an orderly transaction would take place between market participants at the measurement date under the current market conditions. Okay, very simple. So shall use valuation technique that are appropriate, maximizing the use of observable inputs, minimizing the use of unobservable inputs. So this is what is going to be your thumb rule. This is the rule. Okay. So inputs to valuation techniques, observable inputs. This is based on market data obtained from independent sources like prices on the stock exchange or gold rate on the commodity exchange, etc. Whereas unobservable inputs based on entities' own assumptions. This is highly subjective. This is objective. Okay. So inputs to valuation techniques, we discussed level 1 inputs. These are quoted prices on active markets for identical assets or liabilities. Identical. Maruti Suzuki shares you are holding, Maruti Suzuki price is available. Same to same. Okay. All right. So this is what is going to be your level 1 input. Okay. Next, inputs other than quoted prices included within level 1, observable for the asset or liability directly or indirectly. So quoted prices for similar assets or liabilities requiring certain adjustments, like 21 karat gold, we determine using a 24 karat gold valuation. We determined the valuation of Hyundai based on Maruti plus minus some adjustments. So that becomes your level 2 inputs. And then level 3 inputs, all the assumptions in the valuation of shares of cred, use of Black and Scholes model, etc. All these become your level 3 inputs. Okay. So this is your hierarchy. This is your hierarchy. Level 1 is the best. Level 3, I won't say the worst. It is the degree of subjectivity. Subjectivity increases down the line. Objectivity decreases down the line. Okay. All right. So this is your level 1 inputs. Okay. So this one, DS Limited holds equity shares of a private company. In order to determine the fair value of the shares, the company used a discounted cash flow method as no similar shares were available in the market. Under which fair value level hierarchy will the above inputs be classified? Come on, tell me fast. कौन सा level होगा ये? Level 1, 2 or 3? Level 3. Great. So level 3. Okay. What will be your answer if the quoted price of similar companies were available and can be used for fair valuation? What do you think? Level 1 or level 2? Yes. Excellent. Part of unobservable inputs. Absolutely right, Jay Srivastav. Okay, so it will be a level 3. So Hum is right, Sumit is right, Aniket Jain, Manini, Kaushiki. All of you are right. Next one, yeah, this is a level 2 valuation. Balram is there, Manini is there, Kaushiki, Soham, Sumit, Srishti. All of you gave the right. So this is an RTP question. So quite simple, right? Okay. Sometimes what may happen is an observable input is there. You need to make an adjustment using an unobservable input. And that results in a significant deviation on the fair value measurement. Then the resulting measurement would be categorized within level 3 of the fair value hierarchy. Okay. Level 1 is only for listed company. Yes. So not only listed companies, मैंने तो equity का example दिया था. You can take gold listed on the commodity exchanges. That is also going to be level 1. Okay. All right. So that is how you can view it. Okay. So depends. But yeah, there should be a ready market available जहां से आप price उठा सकते हो. So that will become your level 1 input. Okay. I took the example of equity because it is easiest for us to understand. Okay. All right. So level 1 inputs plus minus adjustments gives you some fair value. Ordinarily, this will become level 2. These adjustments and inputs together will become level 2 inputs. Okay. 1 second. Level 2 inputs. Okay. Now, it may so happen that the fair value that we get, and when we compare it to the level 1 inputs, the variation between both of them is quite high. The variation is quite high. Sir, what do you mean by quite high? 50%, 75%, 100%, 200%, 500%, 2%. What is it? It's not given. They are just saying that it is significantly higher or lower fair value measurement. So this is a judgment call, principle based. So you can take a call. What do you mean by significantly high or significantly low, depending on the materiality and other factors. If that is the case, if it results in a significant amount of adjustment, then and only then, though it is based on the level 2 concept we discussed, we will still classify it as level 3 inputs. We will still classify it as level 3 inputs. This becomes an exception. This becomes an exception. Have you understood this? Have you understood this part? Yes. Have you understood this? What is significantly high or low? It is not mentioned in the standard anywhere. It is not mentioned in the standard anywhere. Okay. Like we took a 5% illiquidity discount. That may not be significant. Somewhere they'll take a 20% discount. That may be significant. Okay. So that is all a matter of judgment. But what the standard tells is when there is a significant variation, then you cannot call it as a level 2 input. It will move on to be a level 3 input. Okay. So this is one same thing. They have given an example. Pad lo, nothing important. Okay. All right. Okay. So छोटे examples हैं. An entity is holding an investment which is quoted in the BSE India as well as New York Stock Exchange USA. Significant activities are being done at BSE only. So BSE becomes your principal market. Principal market, you will take values in the principal market. Fair value would be reference to the quoted price at BSE India, which is the level 1 fair value. direct quoted price with no adjustments. So ये हो गया level 1 we have discussed. Level 2 inputs, you are having an interest swap contract. Interest swap means what? It is a contract whereby you exchange your variable rates of interest into fixed or fixed into variable. So this is known as an interest rate swap. Suppose you have taken a loan which is based on the interest rate of which is variable. It is linked to LIBOR or some such kind of interbank offer rate. And basis this interbank offer rate, you will do the valuation. You will do the you will pay the interest. You think that LIBOR is going to increase, and you feel that a fixed rate of interest will keep you safer. So you will find a counterparty who thinks opposite. He will think that variable will benefit him. He wants to give up his fixed rate of interest. So you enter into a swap arrangement. You enter into a interest rate swap. Okay, so this is what I know about interest rate swap. Okay. So your interest rate swap is of 11 years. Okay, rate of swap that is given to you is for a 11-year contract. However, the market is having rates for only 10 years, is having rates for only 10 years. So based on the 10-year valuation, you do a 11-year valuation by extrapolating it. So this becomes a level 2 fair value. This becomes a level 2 fair value. Okay. This one is what we have done, Hyundai Limited. This is again going to be level 2 inputs. Okay. So you fairly know what it is all about. Okay. Now, let us come to this particular thing. This is an amendment that has been made. Okay. So far the examples were clear. Yes. So far the examples were clear, guys. All well. Shall we proceed further? Yes. All well. Soham, Manini, Kaushiki, north, south, east, west, all the zone students are there. Good. In level 2, it depends upon future estimation partially. Again, no guidance is there. Okay, no guidance is there. Partially it depends. Okay. So liquidity discount is a present estimation. Okay, whereas DCF is a future estimation. So it partially depends. Okay, I mean, there is no guidance given there. Okay. All right. Now coming to adjustment to quoted price when it does not reflect the fair price. Okay. अभी जरा ध्यान से सुनो. Okay, just pay attention carefully. कहाँ से start करेंगे? Okay. I had taken this example in the last batch. Wanted to avoid it. Okay. Another example. You know this company Cadbury. Okay. It makes chocolates. Okay. I'm not having an idea of the parent company, etc. But I'm just taking this example so that you can understand. Cadbury is a listed company. Is a listed company. Okay. And suppose the shares are traded at 10,000 on the stock exchange. On the stock exchange. Okay. This value was traded on 31st March 2022. So if I have to mention what is the fair value of Cadbury shares, you will say उसमें क्या है? Observable input, stock exchange से value उठाओ, 10,000 is the value. That is what you will show in your financial statements. Now let us come to a twist in the story. Okay. 31st March 2022, evening at 7 p.m. there was a report on a sting operation conducted by one of the media houses, जहां पे insects were found in the chocolates. Insects were found in the chocolates. And that is sufficient. Okay, that is sufficient. Okay. It created a huge upheaval in the market. Okay. It created Cadbury's reputation went to tatters. There was a lot of PR that happened at 7 p.m. Okay. The company could not refuse it. It was picked up straight from their plants. So it was a very justified report that was there. The company was not having proper words to explain itself. On 1st April, the shares opened at 7,000 rupees. Okay. Now tell me, 31st March, markets close at what time? Markets close at 3:30 p.m. 31st March 2022, the markets closed at that time, 10,000 rupees was the fair value. 7 p.m. on 31st March itself, this report came. Insects were found in the chocolates. A question was raised on the hygiene and controls being followed in respect of manufacturing at Cadbury's plants. And immediately you had the ministry and all vowing on public TV, on national TV, that strict action will be taken against Cadbury's. And therefore, on 1st April, when markets open at 9 a.m. or 9:30 a.m., whatever it is, the shares were traded at 7,000. Now I want you to tell me one thing. What is the fair value? So, संभल के सोच के जवाब देना. Is it 10,000 or is it 7,000? What do you guys think? Is it 10,000 or is it 7,000? Srishti is saying 7,000. Manini is saying 7,000. Any other answers? You are preparing the balance sheet as on 31st March. As on 31st March. Sumit is saying 10,000. Kaushiki is saying 10,000. Soham is saying the observable input is 10,000, but it does not represent the actual value. Therefore, it is 7,000. Okay, good. I got some interesting answers. See, it gets boring when everybody gives the same answer. Okay. Kaushik is saying 10. Sumit is saying 10. Others. Okay. Okay. Hari is saying 7. Okay. Let us understand now the balance sheet. You prepare the balance sheet as at what point of time? Is it at the close of business hours? Is it at the close of business hours? Or is it at 11 hours, 59 minutes, 59 seconds in the night? What do you guys think? When do you prepare your balance sheets? Is it at the close of business or is it at 11:59:59? What do you think? When do you prepare a balance sheet? What point of time? Kaushiki is saying close of business hour. Soham is saying at the last second. Yes, I would say that we prepare the balance sheet as on this time, not the close of business hours, because there is no close of business hours in many of the exchanges. Okay. Just to give you an example, suppose you have Indigo. Okay. See, look at the practical difficulties that we face. Okay, suppose we have Indigo. Okay, ideally office hours closes at 6 p.m. Office hours close at 6 p.m. Okay, but suppose somewhere there is a flight that takes off at 11:55 p.m. That takes off at 11:55 p.m. If the flight takes off at 11:55 p.m., the company would have received the advance bookings for that flight. Revenue can be recognized only when the performance obligation is fulfilled. And since the performance obligation gets fulfilled at 11:55 p.m., should the revenue be recognized on 31st March or should it be recognized on 1st April because this event happened after the business hours? What do you think? What do you think? Understand the practical issue now. You have a flight. The obligation was fulfilled at 11:55 p.m., which is after 6 p.m. You had received an advance. You had received an advance towards ticket bookings. And because you received an advance towards ticket bookings, that advance is converted into revenue ideally because you have fulfilled your performance obligation. So when will the revenue be recognized? Should it be recognized on 31st March or should it be recognized on 1st April? Yes, it will be recognized on 31st of March. You cannot tell Indigo 6 p.m. मेरे को बैलेंस शीट बनाना है, 6 बजे के बाद कोई फ्लाइट टेक ऑफ नहीं होगा, कोई फ्लाइट लैंडिंग नहीं होगी, वी विल स्ट्रेट अवे रिज्यूम ऑपरेशंस ऑन 1st April. कैन यू रियली डू दैट? कैन यू stop operations? It's a very costly thing if you are going to stop operations, okay, just because you have to prepare your balance sheet. So your balance sheet will be prepared as on 11:59 p.m. That time this will be recognized as a revenue. That time this will be recognized as a revenue. This is not an adjusting event which we have discussed in Ind AS 8. ये adjusting event नहीं है. Adjusting event is events happening after the balance sheet date, which is giving you information as on the balance sheet date. ये adjusting event नहीं है. This is happening before the balance sheet date ends. So it is not an adjusting event. It requires adjustment on 31st March itself. Adjusting event means events have happened after 31st March. अरे यहाँ पे the obligation is fulfilled before the balance sheet date is over. 31st March के पहले the obligation is fulfilled. Revenue will be recognized. So the facts are already there. The event is already completed before the closing of 31st March, and therefore revenue should be recognized as on 31st March. Okay, for the period 1st April to 31st of March. This is not an adjusting event. This is information about an event which you are receiving before the close of the financial year itself. So my point of doing all this is to help you understand that there is no concept of business hours now. Okay, it's 11:59 p.m. Another example, a customer withdraws cash from an ATM at 11:30 p.m. in the night. When the customer draws cash from his ATM at 11:30 p.m. in the night on 31st March, that means on 31st March closing, that cash balance is not there with the bank. The customer's balance is changed. It should be debited with that amount. This effect will be given in the balance sheet as on 31st of March. Okay, as on 31st of March. And therefore, the concept of business hours, will be fulfilled at 11:59 p.m. And now come back to our original example. Cadbury listed company, 10,000 was the price at 3:30 p.m. 7 p.m. there is a sting operation. Insects were found. As on 1st April, the price dropped to 7,000 because of this sting operation. The sting operation was a fact that was there on 31st of March. So now all those who have said 10,000 answers, what do you now think? Do you still think the value should be 10,000 or do you think it should be 7,000? Do you think it should be 7,000? What do you guys think? It should be 7,000. Excellent. Okay. But as Soham had rightly pointed, a reader of financial statements will look at the balance sheet of the company holding Cadbury shares. Thoda mehnati hai wo, so he will also look at Cadbury share price. He will look, and he knows Ind AS like how you know. So he will say Cadbury's price on 31st March is 10,000. Here it is 7,000. So why is there a gap? Mera share ka value is 10,000. I am taking 7,000. Can I call it a level 1 input anymore? I cannot call it a level 1 input. I cannot call it a level 1 input. Okay. So therefore, in your financials, you will state that 7,000 is the fair value as on 31st of March, but you will mention that it is not a level 1 input. It is not a level 1 input. You will say that it is a level 2 input. It is a level 2 input. Okay. So you can look at, now that you have understood the story behind this, now that you have understood the story behind this, let us now proceed to understand what exactly the standard tells. Certain situations, a quoted price might not faithfully represent the fair value of an asset or liability, such as when significant events occur on the measurement date but after the close of trading. यही हुआ था अपने साथ. Yes, 10,000 was the closing rate. Significant event happened after closing. So 10,000 is not a faithful representative of the fair value. In these situations, companies should adjust the quoted price to incorporate this new information. If the quoted price is adjusted, then the resulting fair value, it can no longer be considered a level 1 measurement. Obviously, na, it is no longer a level 1. By look at the one who is reading your financial statements. He will look in the balance sheet, Cadbury shares appearing at 7,000. On 31st March, Cadbury shares were there at 10,000. And then he will look, भाई दोनों में similarity क्यों नहीं है? Why have the shares dropped by 30% in the fair value in the financial statements? If you don't give that information, then this fellow will go crazy. Okay, he will start thinking stories. Okay, so therefore, उसको शांत करने के लिए you will have to give a disclosure. You will have to tell that this is not a level 1 input, this is a level 2 input. So what you will have to check, companies' policies and procedures should address how these after our events, not after balance sheet date, after our events will be identified and assessed. Control should be put in place to ensure that any adjustments are appropriate and applied in a consistent manner. Okay. You will not predict, Sumit. Are yaar. Come on, now it's getting too much. Huh? 31st March, when are you going to sign your audited financial statements? Are you signing it on 31st March itself? आप बताओ, प्रिडिक्शन की बात कर रहे हो. When are you going to sign the balance sheet? 31st March को रात को ऑडिटर को बुलाओगे अपने ऑफिस में, मेरे को आज ही बैलेंस शीट साइन करना है, आप साइन करो. The earliest you can sign a 31st March balance sheet is on 1st April. 1st April opening of business hours is the earliest when you can sign the balance sheet. Yaar, on 1st April opening of business hours, you already know that the price is 7,000. You already know that the price is 7,000. Are you following? Yes. So there is no question of prediction. There is no question of prediction. When I'm finalizing the balance sheet on 1st April, I know that this adjustment has to happen and we make that adjustment. Okay. That's right. So Kaushik is saying till September you have the time. Yes, you do have the time. So on September, till September, मेरे को definitely पता है that 1st April is a value. Okay. So there is no prediction. Okay. All right, fine. So this takes care of that. So basis this, I leave this for homework. सेम एग्जाम्पल है, कैडबरी को ए लिमिटेड के साथ रिप्लेस कर दो, चॉकलेट्स को क्लिनिकल ट्रायल्स के साथ रिप्लेस कर दो. The story is the same. Okay, pricing थोड़ा change कर दो. 10,000 you replace by 36, 7,000 you replace by 22.5 and everything falls in place. Okay, so homework, just go through it. It's nothing different. It will be a level 2 measurement. It will be a level 2 measurement. Okay, so this takes care of this part. And then let us proceed to approaches to valuation. Okay, approaches to valuation. All right. So we now have something known as the market approach. Market approach means what? Prices and other information generated by market transactions involving identical or comparable assets, liabilities, etc. You are using market multiples derived from a set of comparable companies. Example, EV, EBITDA or PE multiple. Okay. What I'll do is, first, let us do some questions on this, and then I will explain the theory so you can understand it better at that point of time. Okay, we will do some questions on this and then you will be in a position to understand better. Okay, so let us come to this question. Question 3, page 4.110. Okay, what I'll do is, I have myself typed out this. You can take note of this. Okay, but it saves up my time. Okay, so this is the same question. I think it's the same slide also, slide number 35. So the same question is there. Okay, so let us understand how this happens, so you will get an idea what do you mean by market approach, etc., etc. Okay, so now ABC Limited acquired 5% equity shares of XYZ Limited for 10 crores in the year X1, X2. The company is in the process of preparing the financial statements for the year X2, X3 and is assessing the fair value at subsequent measurement of the investment made in XYZ Limited. Okay. Based on the observable input, ABC Limited has identified a similar transaction in which PQR has acquired 20% equity shares in XYZ Limited for rupees 60 crores. The price of such transaction was determined on the basis of comparable companies method, EV by EBITDA, which was 8. For the current year, EBITDA of XYZ is 40 crore. At the time of acquisition, the valuation was determined after considering 5% of liquidity discount and 5% non-controlling stake discount. What will be the fair value of ABC Limited's investment in XYZ as at the balance sheet date? Okay, fine. So let us just understand what the question is telling first. Okay, so I'm having XYZ Limited. Okay, who has acquired the shares? ABC has acquired 5% shares. Has acquired 5% shares. Okay, आप किसका देखोगे? what will be the fair value of ABC Limited's investment in XYZ Limited? So you are doing a fair valuation from the perspective of ABC Limited. Okay. All right. Now, comparable transaction. Comparable transaction. What is the comparable transaction? PQR acquired 20% shares for rupees 60 crores. Okay. PQR Limited, 20% stake, 60 crores. Hey, how much ABC Limited has paid? 10 crores. Okay. And now we will have to do a fair valuation of these shares. We will have to do a fair valuation of this 5% stakeholding. Okay. Karte hain. What's the big deal? Okay. So what is given is the EBITDA of XYZ is 40 crores. Okay. So EBITDA is equal to 40 crores. Okay. So now I will have to do the valuation. Now I will have to do the valuation. So I will have to find a comparable company for XYZ Limited. I will have to find a comparable company for XYZ Limited. Okay. Who has identified, ABC identified a similar transaction in which PQR has acquired 20% shares for 60 crores. And this price of 60 crores was based on the enterprise value divided by EBITDA multiple, which was 8. So this is my comparable. This is my comparable. And this price of 60 was determined based on EV by EBITDA multiple of 8. What is multiple? Multiple is basically a figure that helps you to arrive at the share value. Okay. So there are PE multiples. There is EV by EBITDA multiples. It is a multiplier. Okay. It is a multiplier. You could have PE, you could have EV by EBITDA, etc. What do you mean by EV? EV means enterprise value. EV means enterprise value. What is enterprise value? Value of debt plus value of equity plus value of equity. That together becomes your enterprise value. So the question is telling that this value was determined based on this multiple of 8. Now, I want to find out what will be the value of this 5%. What will be the value of this 5%? Very simple. EV by EBITDA, this is equal to 8. What is the EBITDA of XYZ? Ye iska hi multiple hai. It is this multiple only. Therefore, enterprise value is equal to 8 into EBITDA, which is 8 multiplied by rupees 40, which is 320 crores, which is 320 crores. Okay. Next one. Next one. At the time of acquisition, the valuation was determined after considering 5% liquidity discount, 5% non-controlling stake discount. Okay. No debt. Debt के बारे में कुछ दिया नहीं है. So debt will be taken to be nil in this case. So this enterprise value is equal to value of equity. Value of equity. What stake? Sir, this is 100% stake. This is EV EBITDA multiple of XYZ. So enterprise value of XYZ will be 320. That means 100% equity will be 320. EBITDA stands for earnings before interest, tax, EBITDA, depreciation, and amortization. So this is the meaning of EBITDA. Earnings before interest, tax, depreciation, amortization. It is a very, very, very crucial figure in valuations. Okay. EBITDA basically is the earnings that a company generates on account of operations. Okay. It is eliminating depreciation and amortization. It is earnings before depreciation, amortization. That means it is focusing on the cash that you are able to generate. It is eliminating interest. So that means financing ka jo impact hai, the impact of financing is also eliminated. So this is more like a operations related cash income that you are generating. And it is a very crucial figure for the purposes of valuation. Okay. So ye ho gaya mera EV by EBITDA multiple. So I have determined the enterprise value, which is equal to the value of equity, because debt is nil. They have not given any debt, so debt is nil. So equity value of 100% stake is 320 crores. Okay. Now stake of valuation kiska kar rahe? We are doing valuation of XYZ Limited. So 320 crores into 5%. भाई छोटा सा है अपना. Okay. So 320 into 0.05. This is 16 crores. This is 16 crores. Now, in the question, they have said there is a 5% liquidity discount. That means the shares of XYZ are probably not listed, and therefore the liquidity discount applies an asset specific feature. 5% illiquidity discount. So this comes to rupees 0.80 crores. 0.80 crores. Okay, fair enough. So far, have you understood, guys? So far, have you understood? Yes. Are you able to follow, or ये ऊपर से जा रहा है? Are you able to follow, or is it like getting too technical? Be honest. Okay, be honest. नहीं समझ रहा है, बोल दो नहीं समझ रहा है. Yes, sir, it's clear. Kaushiki, Srishti, Manini, all of them are saying it's clear. Okay. Then there is another 5% discount on account of something known as non-controlling stake discount. See, we have chosen a comparable transaction as PQR acquiring a stake in XYZ. This comparable transaction was for a stake of 20%. Somebody holding 20% is sizable. Sizable in what sense? This fellow is going to get, PQR Limited is going to, generally when your holding touches 20%, it means you're holding 1/5 of the company. And therefore 20% means PQR Limited can exercise significant influence over XYZ. When you study Ind AS 103, 110, 111, these standards discuss with this understanding. Okay. So PQR Limited is holding 20% stake, means PQR can significantly create an influence over XYZ. How does it create influence? By appointing a director. So just because PQR holds 20% shares, it will nominate a director to sit on the board of XYZ Limited. It will nominate. Mil jata hai ye. But ABC Limited is holding just 5%. कौन सुनने वाला है? कोई सुनने वाला नहीं है. Nobody is going to listen to ABC Limited. It is like you and I purchase 10 shares of Reliance. कहने को तो हम कंपनी के मालिक हैं. Strictly speaking, we are owners because we are shareholders. But 10 share में क्या होने वाला है? Who is going to listen to us? Nobody is going to listen to us. Okay. So this 5% is not getting any representation on the board. That means this transaction is advantageous compared to this one. Disadvantageous. Why is it advantageous? Because of the stake. Because of the stake. So this is an asset specific characteristic. It's not entity specific. It is asset specific. You are holding 20%. Here you are holding 5%. So this holding percentage is lower in your case, which is ensuring that you are not getting a seat on the board of directors, and therefore we will have to give a discount for this. So we call this as a 5% non-controlling discount. So this goes another 0.80 crores. So 16 minus 1.8, 1.6, sorry. 1.6. So the fair value is going to be 14.4 crores. Fair value 14.4 crores. Is it okay? Yes. All clear, everyone? Any doubts? Please confirm. Any doubts? No doubts. Okay. Kaushiki confirmed. Soham, Manini, Aniket, all of them have confirmed. Okay. So if you look at this solution, yeah, so it's basically the same. So what I'll do is I will be giving you, I'll be uploading today this PDF, okay, wherein I have written all the things that I have explained. So you don't have to write so much in your exam. In your exam, what matters is only this, okay? So, okay, Srishti Goyal is saying, how can controlling stake affect the fair value? Okay. कौन है भाई ये? ABC PQR. Okay. PQR Limited acquired 20% stake. ABC Limited acquired 5% stake. Because PQR acquired a 20% stake, what is it getting? It is getting shares plus right to appoint right to a seat on the board of directors, whereas ABC Limited is getting only shares. ABC Limited is getting only shares. So tell me one thing, if PQR is getting a right on the board of directors, a right to a seat on the board of directors, do you think PQR will pay? Don't you think PQR will pay a premium for this? भाई उसको दो चीजें मिल रही है. It is not only getting shares, it is getting a seat on the board of directors. So PQR is getting two things. Jabki ABC is getting only one thing. that is shares. So when I take this as the comparable transaction to determine the value of shares, I will have to subtract this, right? Because this comparable is shares plus a right. I have to value only the shares. That means from the comparable, I will have to deduct this. So that deduction is this 5%. That is this 5%. Okay. It is this 5%. Have you understood now? Srishti, have you understood? Have you understood? Yes. What is 60 crores? 60 crores is what PQR has paid to get the shares of XYZ Limited. I don't have to do anything with that 60 crores. 60 crores, how it was determined is given to you. It was determined by EV by EBITDA multiple of 8. All right. EV by EBITDA was 8. And then when we move on to EV by EBITDA is equal to 8, and then you are having 40 crore क्या था? EBITDA. $40 crores. So this entity's enterprise value is equal to 320 crore. ये मिला अपने को. We got this. Basically, what they're trying to tell is this 60 crore value is determined based on the enterprise value of 320 crore. That's it. I'm not going to use this 60 crore anywhere in this valuation because I'm not valuing from perspective of PQR. I'm valuing from the perspective of ABC. By my holding is 5%, I will use this enterprise value for the 5% stake. But then when the enterprise value was 320, it gave two things. One is right to the seat. So that I am deducting. And the second one is illiquidity discount. The shares of XYZ are not tradable. So a discount there. Okay. So that takes care of Kaushiki's question. You will not use the 60 crore anywhere because wo apna transaction hai hi nahi. It's not our transaction. Okay. All right. Sanket has asked a question. Present value is totally based on estimates, but in real life, how is the process to decide the present value? Like, what are the parameters used in real life? Okay. See, it's totally judgmental. I again repeat, okay, it's totally judgmental. Okay. So for instance, there was an acquisition which we had, and in this acquisition, the target company had a binding contract with a customer, okay, with one of the major listed entities, a binding contract to sell goods for a period of 5 years. And this becomes a major source of revenue for the parent company, which has acquired the target company. Okay. So when I acquire the target, I'm not only acquiring the assets, the liabilities, plants, not that. I'm also acquiring a customer contract that is going to exist for the next 5 years. So it becomes an intangible asset. It becomes an intangible asset. Now, how do you value this intangible asset? Well, you will have to look at what is the commodity quantity that you are going to supply in the future. What is the price at which you're going to supply in the future? Is there any escalation clause which is given? Is there any cost savings that you will incur in the future? Is there any cost savings that needs to be passed on to the customer in the future? So all these things you will have to evaluate at the time of determining the intangible asset, which is my customer contract, Okay, so there are a lot of things, and then there may be some contracts without, there may be some relationships without any binding contract. It is going on and on because you have developed a relationship with that client. So there is no binding contract. You can look at the past trends, notice a pattern, and then basis that you can determine the future growth rate, revenues, costs, etc. So basically, there are no parameters defined in the standard. It's not possible. It's not practical. You will have to determine. Ultimately, you are having certain valuation standards also. Myself, I'm not an expert in valuation, so I do not know. But there are certain standards in valuation which state that your cash flows cannot be such and such percentage. Your EV EBITDA ratio, I mean, your certain ratios like operating cash flow ratio to total cash flow ratio cannot exceed so much, or investing cash flow can be so much percentage of the total. So in your valuations, these are the parameters which are prescribed by the valuation standards, not the accounting standards. Okay. So these parameters coupled with what the tax laws prescribe, coupled with what valuation standards prescribe, basis that you determine the fair values. Okay. It is a very complicated process in practical life. Fair valuation is a nightmare for many companies. Okay. Because it's not so easy. It's not at all so easy. Isiliye, even though you have many listed companies, you can see that the valuations of property, plant and equipment, they prefer to follow the cost model only. They do not prefer to go for the other model, that is the revaluation model. Because kaun karega fair valuation? Every fair valuation comes with a huge cost. Okay. You have to apply a lot of mind, engage consultants to do the valuation, and on top of that you will give the MRL. Okay, so ultimately there is a lot of estimates involved. No parameters prescribed as such. What gives you a true and fair value, you will be ultimately doing that. Okay, all right. PV depends upon discount rate. Can it be different for different entities? Yes, it can be different for different entities. Yes. But you will think from the perspective of a market participant and apply to your case. Okay, and apply to your case. Okay, so that takes care of this question. Okay, let us move on to the next question. Let us move on to the next one. Okay, I'll proceed with the next question. Forget these words for the time being. Okay, just don't look at this. Let us understand how the valuation happens, and then we can understand the approaches better. UK Limited is in the process of acquisition of shares of PT as part of business reorganization. The projected free cash flows for the next 5 years are as follows. You are given cash flows and the terminal value. The weighted average cost of capital, WACC, is already given to be 11%. Total debt as on the measurement date is 1,465 crore. Surplus cash and cash equivalent is 106.14 crore. So therefore, can I say that my net debt is equal to 1,465 minus 106.14? Okay. 1,465, 106.14, 1,358.86. Okay, 1,358.86. So this is what is going to be your net debt. Okay, total number of shares is 8 crore 52 lakhs. Determine the value of PT Limited. Okay. Now, what all is given to you? You are given these values. Okay. Abhi, this is not accounting. Okay. What we are doing right now is little bit of SFM, but institute ka bharosa nahi, it's included here means it can ask. Okay. So I have just explained some things from the question. Value of the enterprise is equal to present value of all the future cash flows. So cash flows is estimates of cash flows in years 1 to 5. Terminal value means values to perpetuity. See, when you value equity shares, they will be valued based on a going concern. See, when you value bonds, debentures, etc., they have a finite life. 5 साल में redeem करना है, 10 years you have to pay it off. So they have a finite life. But the issue is with equity. Equity does not have a finite life. So beyond some point of time, you have to extrapolate it to perpetuity. So that is known as the terminal value. So year 6 to perpetuity, we normally calculate as price at the end of year 5 is equal to cash inflows at the end of year 6 divided by KE minus G. So this is what is the formula, where P5 is price at end of year 5, D6 is earnings in year 6, KE cost of equity, and G is the uniform growth rate. So this is what is there. Now, if we take the discounting factor, they have already given to you that this discounting factor is 11%. Okay. I'm just going through the solution because it's just calculative. Okay. But we understand the concept. That's better. This sheet will come to you. Don't worry. Okay. This sheet will come to you. So the cash flows are 1, 2, 3, 4, 5. This should not be 6. This should be 5 only. This is terminal value at the end of year 5. So discounting factor 1, 2, 3, 4, 5. See, it is the same here. It is the same here. Okay. So my present value of cash flow 1, 2, 3, 4, 5. Okay, so this present value comes to 3105.77. There was a net debt. This is enterprise value, which is debt plus equity. So from here, I will have to deduct the debt. So debt is what? 1358.86. So when you deduct that, you get value of equity divided by number of equity shares. You will get value per equity share. So that takes care of this question. Any doubts so far? Any doubts? Have you understood this? Yes. I haven't seen Sumit. Okay, I haven't seen. I'll have to check. Okay, guys, any doubts with this? Yes. All right, great. Enterprise value is equal to present value of cash flows. I think I have given it here. Yes, value of enterprise is the present value. See, wherever it is possible, I have put in a little bit of theory. You don't have to write all this in exam. Okay, this is not needed in exam. This is not needed in exam. Okay, solution mein all you need is this part That's it. Only this is required for your examination. That's it. Okay. So it's fairly uncomplicated in that sense. Although I don't know why this is determining the fair value. Okay. This is determining the fair value, not accounting. Okay. All right. We take another question on similar lines. You should be able to chip in with your answers. You are a senior consultant of your firm and in the process of determining the valuation of KK Limited. You have determined the valuation by two approaches. Matlab, you've already determined the valuation by two approaches. That is market approach and income approach. Now you come to this. In the first case, my friends, in the first case, we saw a comparable transaction. We saw a comparable transaction. We took that comparable transaction, made adjustments for illiquidity discount as well as for non-controlling stake discount and determined the value. But the source input is where? It is the market. So we call it the market approach. So we call it the market approach. Now you tell me, friends, will this be level 1 input, level 2 input, or level 3 input? What do you think? We've studied level 1, 2, and 3 in detail. Now you tell me, will it be level 1 input, what we did? Which question you're talking, that ABC Limited acquires a share in XYZ using a comparable of PQR in XYZ with the EBITDA, EV EBITDA multiple of 8. You tell me, will it be level 1 input or level 2 input or level 3 input? Come on. Level 2. Level 2. Absolutely right. Srishti is saying level 2. Anybody else? Anybody else? No, there is one more approach, Sumit. There is one more approach. I'll be discussing that. Okay. एक और approach है. Yes. Anybody else, guys? All right. Everyone is saying level 2, which is correct. So this is your market approach. Then we did the next question, which is based on future cash flows. Cash flows means income. So we call it as the income approach. So we call it as the income approach. Now you tell me, is this level 1, 2, and 3? Which input based on what we have solved? What do you think? Is this level 2? Aniket Jain, it is level 2, not 3, because we took a comparable and made some small adjustments. Okay. Yes. Srishti, level 3, estimates at each step. Manini also is saying because of estimates at each step. Okay, so that's right. So this becomes a level 3 input. Yes. So Hum also is saying level 3 input. Okay, so great. Excellent. Okay. So the next question combines both of them. Aap kar sakte ho. You have determined the valuation by the market approach as well as the income approach and selected the highest as the final value. However, based upon discussion with your partner, you have been requested to assign equal weights to both the approaches and determine a fair value of shares. So as per market approach, this was the value. As per income approach, this is the value. The debt obligation is given, surplus cash is given. So this can be used to arrive at net debt. Okay. Fair value of surplus assets and liabilities. We will see what these are. Number of shares, 8.52 crore. determine the equity value. So given values, we assume they are enterprise values. So since weights are equal, we will assign 50% to both of them. We will assign 50% to both of them. Okay. Now, 5268 into 50%, 3235 into 50%. So basically, this is nothing but weighted average. Weighted average. So this comes to the weighted average 4251.70. Because it is 50-50, you could also have simply done 5268.2 plus 3235.2 divided by 2, because it is 50%. If they had to give assign 70% to market approach, 30% to this, then you would have to continue with this format. Okay. With this method. All right. So 4251 minus net debt gives you this. Then there is something known as surplus assets and liabilities. Again, you will study this in SFM, but I have given to you since it's there here. Surplus assets and liabilities, they are considered to be non-income generating assets since they are surplus. For example, idle land held for capital appreciation. This is an investment property without giving income. इसको हम लोग बोलते हैं surplus assets. Their impact would not be considered in the income approach because it's not giving me income. Okay. And neither is it considered in the market approach because PE multiple, EV EBITDA multiple, EPS EBITDA multiple, EPS means earnings per share. Okay. So all these have earnings, everywhere earnings means earnings come from assets which generate income. So surplus assets do not give me income, so it is not included in this enterprise value. It is not included in this enterprise value. And because it's not included in the enterprise value, we will have to add it in our valuation, because when you are getting the shares, it is a representative of all the assets and liabilities of the company, including the surplus assets, which does not generate any income at present. And therefore, this one minus net debt plus the fair value of assets and of surplus assets and liabilities divided by number of equity shares, which gives you value per equity share of 375.72. So this is your third question on valuation that is there. Is it okay, everyone? Is it fine? Have you guys understood? Yes? Have you understood? Have you understood this? Yes, sir. Sanket has understood. Okay. See, enterprise value. I told you, no? We have assumed that these are enterprise values. What do you mean by enterprise value? Debt plus equity. I am valuing equity. Therefore, equity is equal to enterprise value minus debt. Okay. So that is why Srishti, it needs to be halved because of this statement. You have been requested to assign equal weights to both the approaches. Equal weights means 50% for market approach, 50% for income approach. If they had to tell 70% for market, 30% for income, you would take it as 70% for market. So 70 into 5268 and 30 into 3235. Okay. All right, so that takes care. WACC typically would be typically it would be after tax. Yeah. Net debt is 1359.76. मैंने क्या लिखा है 86 यार, 0.1 माफ कर देना, ठीक है 0.1 माफ कर दो. ओके, ऑल राइट. All right. So Srishti, your query was addressed. Okay. Anyways, okay, in market approach example, we have deducted 5% of non-controlling as we have discussed, as we have used a comparable transaction. Why did we deduct illiquidity discount? As it would already be there in a comparable transaction. Understand the question. Question को समझो. Okay. PQR Limited paid 60 crores. It paid 60 crores based on this multiple. How did I get this multiple? This 8, how did I get? I looked at another comparable transaction on the stock exchange. I looked at another comparable transaction on the stock exchange. So if they are a comparable transaction on the stock exchange, this 320 crore will include the liquidity of the stock exchange, and that is why we deduct that. That is why we deduct that. Is it okay, Kaushiki? Yes, that is why we deduct it. No problem. You ask questions, don't worry. So this I explained, this is also explained. Okay. This 60 is dependent on this multiple. This multiple comes from a comparable market value. Okay. All right. Now coming to the next question. Good. Sir, if surplus asset and liabilities are of no use to both the approaches, then why to even add it? Well, you will add it because ultimately your equity value is including the assets. No, you cannot ignore some assets and say that we will not consider it in equity valuation. When you determine value as per income approach, it will be based on the assets which give income. But suppose you have a very, very pristine piece of land, a very in the heart of the town, a very costly parcel of land is there with you where you've not done anything. Don't you think its value should be included in the value of equity, because then the company's worth is higher? For that reason, we will have to add it. Okay. For that reason, we will have to add it. Okay. 8 is multiplier of EBITDA. Yes. It is a multiple. It is a multiple. Okay. We take that multiple multiplied to my EBITDA to determine the enterprise value. To determine the enterprise value. Okay. So have you understood all the 3 questions, everyone? Anybody having the slightest doubt in even one question? As anybody having slightest doubt in one question, please ask. I'm giving you some time. All the 3 questions clear. Balaram, Sumit, Aniket, Pradeep, Hari, Kaushiki, Manini, Sandhya. All clear? Yes, sir. All clear. Okay. So that kind of should make us understand what is my market approach, what is my income approach. So now we come back to our theory. Now we come back to our theory. Market approach, what did we do? Uses prices comparable, involving identical or comparable assets. We saw in that question, we took the transaction of PQR limited, EV EBITDA multiple of comparable, and then we made certain adjustments. So typically this becomes a level 2 approach. This becomes a level 2 input typically. Okay. Typically. Okay. Sometimes it can be level 1 also. Straight away take identical and finish it off. So this is my market approach. Income approach, Gordon's formula, DCF method, blah, blah, blah. Everything is uncertain. So this is a level 3 input typically. Okay. Cost or asset approach. This is nothing but net asset value or book value. So what are you going to do is you will see how much cost is required to replace existing asset. All related costs will be its fair value. So using a replacement value method. So you are having this one also. ये भी हो सकता है level 2 or 3. Level 2 or 3. Okay. Replacement cost method. Okay. So these are the 3 approaches to valuation. These are the 3 approaches to valuation that we follow. Okay. See, I'll finish up to liability and equity and then give you a break. Okay. Best approach is obviously market approach. No doubt. That's right, Sanket. Best approach is market approach. No doubt. It is easy to calculate, most fair, and easy to audit also. So market approach is the best one. Okay. So I want you guys to do this homework. You should be able to get this now. We have done a lot. Okay. हम लोग ने बहुत किया है, आपको समझ में आ जाएगा. You have to see which is my comparable transaction. Okay. So there is a investment with a contractual right to receive 800 in 1 year. There is an established market for comparable assets. So in the comparable assets, you are having investment 2 being a contractual right to receive 1200 in 1 year with a market price of rupees 1083. You are having another investment with a contractual right to receive 700 in 2 years and has a market price of 566. All 3 assets are comparable with respect to risk. Measure the fair value of asset 1. You are having one asset, that is investment 1, and you have 2 comparables, investment 2 and 3. The question is, which comparable are you going to use for determining the fair value? And using that comparable, what will be the fair value of investment 1? Okay. So my investment is to receive an amount in 1 year. So I will look at those comparables where amount is to be received in 1 year, because that is closest to my value, that is closest to my investment. Okay, so 3 is not going to be comparable. What is going to be comparable is investment 2. So using this, we determine the discount rate. How do I know the discount rate? Sir, I am getting future value as 1200. FV लिखोगे, बोलोगे fair value. Future value 1200. Present value is 1083. This is the fair value. Future value after 1 year. Present value, that means today it is 1083. So I can get the rate of interest. I can get the rate of interest. Today 1083, 1200 after 1 year, what will be the rate of interest? And then basis this rate of interest, apply it to this 800. So 800 is after 1 year. So applying this rate of interest, what is going to be the value? You should be able to get this. Quite simple. Okay. All right. This is homework. It is simple. Nothing much to be discussed. We have done this question. We have done this question. we have done this question. Okay. All right. And then last question, we will do it an RTP question. Is it okay so far? Are you fine? That one question, can you try for me? This is the last question. Then we move on to liabilities and equity valuations. Okay. What are the principles there? Is it okay? Can you try it out for me? Oh, the question that we just now did is asked in November 2022 exam. कौन सा this one? This is just now asked. Okay. For 5 marks. Great. Okay. All clear so far? Yes. Okay. Great. Fine. Fine. Yes. Okay. All right. So that takes care of this one. We pick up the last question on fair valuation of investments, and then we move on to own equity and liability valuation principles. Okay. Entity A owns 250 ordinary shares in XYZ, an unquoted company. XYZ has a total share capital of 5,000 with a nominal value of 10. Nominal means face value. Okay. XYZ's after tax profit. So profit after tax is equal to rupees 70,000. Okay. An appropriate PE ratio is 15. PE is 15. This is comparable. Okay. Entity A's management estimates that the discount for lack of marketability is 20%. ठीक है, तो price is equal to 15 into 70,000. So that comes to 10,50,000. 10,50,000 minus 20%. That is the illiquidity discount. So 10,50,000 into 0.2. So 2,10,000. So when you subtract this, you get how much? 8,40,000. This is your fair value. Divide it by 5,000. So 8,40,000 divide by 5,000. So that gives you 168 per share, multiplied by you are holding how many shares? 250 shares into 250. So the fair value that you would have determined is rupees 42,000. Simple, simple. Yes. 8,40,000. I hold only 250. So divided by 5,000 into 250. So that takes care of part 1. Part 2, based on the facts given, estimates the fair value using net asset valuation technique. Value of net assets is 8,50,000. तो कुछ नहीं यार, 8,40,000 हटाओ, 8,50,000 करो. So this comes to 170 and this comes to 42,500. That's it. Okay. So quite simple. Okay. Have you understood these last two questions? Yes. Everyone seated, attending, have you understood? Yes, sir. Manini has confirmed. Srishti, Aniket, Sumit, all you guys have understood? Yes. Okay. So that takes care of this part. Net asset value you won't, because you are valuing based on asset values. तो उसमें marketability क्यों आएगा? It's based on what the company has, right? So there is no need to adjust marketability. It's not a comparable, it's not a marketable values which we are comparing. Okay. All right. So we take a 5-minute break. It's 9:05, 9:06 right now. We take a 5-minute break and then we shall resume with fair value rules for liabilities and own equity. Okay. So we take a 5-minute break, guys. 9:11, 9:12, we should be back. Okay. All right. So that's it. See you in 5 minutes. Okay. Okay. All right. Welcome back, guys. So we move on to the next part of the standard. It's relatively small. We've covered the major rules, regulations, understanding, valuations, appropriate market, everything. Okay. So the major part is done. Now, two small things: fair value rules to liabilities and own equity. Okay. So even liabilities have to be fair valued. Equity also, sometimes there will be some instruments that need to be valued. Okay. When would you have fair valuations of own equity instruments? Well, when you are issuing equity in business combinations, that time your equity should go at fair value. So you need to conduct a fair valuation of your equity which you are going to issue. You will have to value a liability which could be a financial liability or it could be a non-financial liability. Okay. So the fundamental assumption, there is one assumption which is made, and that is key: the liabilities or equity instruments will remain outstanding on the date of measurement. That means we will presume that these liabilities are not getting extinguished. Extinguished means what? It becomes zero. हम assume करेंगे कि the liability is only getting transferred. We are not assuming that the liability is being paid off or settled. Okay. So the same thing continues. Use all observable inputs, minimize unobservable inputs, and should be evaluated in an orderly, in line with an orderly transaction, should not be entity specific. So very simple guidelines, what we have already studied, nothing different. Okay. It's absolutely the same. Okay. So the reason we take assets first and then we come to equity and liability is because by now you will understand all the terms quite comfortably. So should not be taking much time. Okay. So this is the first part. So we assume that the liabilities are not settled. They would remain outstanding. We are only transferring the liabilities. Okay. So we have a question on this. See, the institute has given a particular flow of the way the standard is in its chapter. Okay. That is the way the standard is presented. Okay. I have covered everything, but my flow is going to be slightly different from what is there in the study mat. Both are correct. Don't worry. Like, I have left 2 to 3 things. One is this example, which I am discussing now. It is example number 2 in your study module, but for us, it is going to come now as a discussion. Secondly, there was something known as unit of account, which I'll be discussing later. And the third one is, yesterday, I think Srishti or somebody had asked in the last class, sir, if it is an entry price for somebody, it will be an exit price for the other. How do we do that? So this is the last part of today's discussion. So these 3 things we will be discussing right now. Okay. A bank holds a debt obligation. Okay. So now let us understand this. You can read the example later on. I'm not worried about the example. Okay. I will help you to understand the example in a simple term. In simple terms. Okay. See, you have SBI. You have A Limited. Okay. And you have B Limited. A Limited had issued a bond to SBI. This bond is having a settlement value of 1 lakh. Settlement value of rupees 1 lakh. What do you mean by settlement value? Well, settlement value means for the liability to be extinguished, you will be paying 1 lakh rupees. For the liability to be settled, you will be paying off 1 lakh rupees. You can take it to be the face value. Face value. However, the same bond is quoted in the market for 95,000. market price, is quoted in the market for 95,000. Okay. Now, why this 5,000? Well, the market probably presumes that A Limited may not perform. So that is inbuilt in the market price of 95,000. Okay. Now, SBI says, मेरे को 1,00,000 चाहिए. I have given you 1,00,000 rupees. I need my money back. ये bond का 1,00,000 face value जो है, what is the face value? I want it repaid back. I will not settle for 1 paisa less. A Limited wants to repay it. Think from the perspective of A Limited. A Limited has issued its bond. Today, the market price of that bond is 95,000. It wants to settle, or it wants to come out of this liability, not settle. It wants to come out of this liability. So remember, what did we understand about the definition of fair value? Fair value is the price, okay, to sell an asset, number one. अभी asset की बात नहीं हो रही है, or paid to transfer a liability. So what A Limited will do is, A Limited अपने जैसा एक कंपनी ढूंढेगा. It will search for another company similar to it. It found a company B Limited. B Limited को immediately पैसा चाहिए. B Limited needs the money immediately. बैंक के पास जाएगा, ITR दो, डेटा भरो, give me the projections, financials दे दो. उसके बाद भी there is no guarantee that the loan will be sanctioned. So A Limited tells B Limited, Dekh, you and I are on the same platform. Our risk profile is same. Our earnings, business, everything is similar. And you need the money. I have the money. So what A Limited will tell, look, I will transfer this liability to you. I will transfer this liability to you. And I will pay you 95,000 for that. B Limited says, मेरे को कुछ नहीं देना है. नहीं, you don't have to give anything. Yours and my risk profiles are same. We do not have to go through the experience of bank documentation. I'll give you 95,000. You take this obligation. On the maturity date, SBI will come to you. That time you will pay SBI 1,00,000 rupees as the settlement value. B Limited says, मेरे को क्या है? I'll pay 1,00,000, no problem. Right now you give me 95,000, no problem. So this 95,000 is what becomes my transfer value and quoted in the market. So this itself is my fair value. This itself is my fair value. Tell me one thing, the moment this liability is transferred from A Limited to B Limited, now answer the question carefully. Answer the question carefully. When A Limited transfers the liability to B Limited, is the liability extinguished? Is the liability settled? Or is it still outstanding? Is it still outstanding? Is the liability settled or is it still outstanding? Liability is still outstanding. Yes, liability is still outstanding. From the perspective of A Limited ने अपने सर का बोझ जो था, the burden that was there on A Limited's head, it removed that burden and put it on B Limited's head. But liability still exists. Not with A now. It will be there with B Limited. It is like saying an asset. You transfer an asset from A Limited to B Limited. After transferring the asset, your asset continues to exist. Na? That is why we do asset first, because asset mein people are very clear to, are very comfortable to understand. Liability mein what happens? We tend to go crazy. We don't understand because we don't deal with this on a regular basis. You look at the perspective of that bond. The bond was there before also. The bond will be there afterwards also. It's just that it is being transferred from one entity to another entity. So liability is still outstanding. It's not getting settled. From the perspective of the bond is still alive. The bond में अभी भी जान बाकी है. And when this bond has to be repaid, how much will you pay? You will pay 1 lakh. 1 lakh is not the market value. 1 lakh is the settlement value of the bond. It is the face value which you will pay in accordance with the bond terms. This is not a bond swapping. This is not a bond swapping or interest swap. You are transferring the liability. That's it. Okay. It's not a swap contract. आपको बदले में कुछ नहीं मिल रहा है. You are giving 95,000 along with the bond कि भाई ले जा और मेरे सर से वो liability खत्म हो गई. Okay. So from A Limited's perspective, there is no liability, but the liability as such still exists in the market. And since the market price is 95,000, the fair value is 95,000. The fair value is 95,000. If B Limited won't pay, then A Limited will pay to SBI? No. This transaction will happen keeping SBI in confidence. Okay. A Limited has to tell SBI. See, the bond document will be with whom? See, when A Limited issues a bond, it will give a bond document. No. That bond document will contain A Limited's director stamp, seal, everything. So A Limited has to go to SBI, collect that bond document, give it to B Limited. It will be in the name of now B Limited. A Limited, so SBI will not go to A Limited. SBI will go to B Limited. All obligations, etc., repercussions, penalties for default, everything will now hit B Limited. Everything will now hit B Limited. Is it okay? So if there is a bond document in A Limited's name with SBI, SBI can come to A Limited in the future. So A Limited should ensure that that document is removed from SBI and replaced with a bond document naming B Limited as the customer. Naming B Limited as the customer. What is quid pro quo? Is it not fulfilled? Is it a... Why do you need a quid pro quo? See, don't think as an asset. A Limited has a liability. B Limited needs money. Okay. B Limited needs money. Okay. So what entry A will pass? A will pass the entry liability account debit to bank. 95K, 95K. B Limited will receive the liability. So it is getting the money as well as the liability. Now it is not an asset. B Limited gets the money with the intention that it has to pay it later on. So the quid pro quo for A Limited is it pays the money now so that it will not have to pay 1 lakh in the future. That is the quid pro quo. That is the quid pro quo. So the liability is transferred, liability account debit to bank. This is not paid to SBI. This is paid to B Limited. B Limited will record 95K as a receipt and book a liability in its name. No quid pro quo means what? Why do you need a quid pro quo? A Limited is paying 95,000. In return, what A Limited is getting? The liability is going from its head. So see, we are used to thinking when I pay an asset, I'm getting some, when I pay for an asset, I'm getting the asset in return. Now think opposite. You are paying and in return, a liability is going out from your books. So it's the same concept. Only thing is replace an asset with a liability. आपने पैसा दिया, liability आएगा नहीं, liability is going out from your books. Okay, so the liability is getting transferred. So that itself is the quid pro quo. That itself is the quid pro quo. You are paying so that your liability is taken off from your head. Okay. Difference of 5,000 will be booked later on when it is being settled. When it is being settled. Right now, the transaction will be recorded at fair value. Right now, it will be recorded at fair value. Is it okay? Have you understood? So this question deals with that only. Okay. ये वही है. If I had to read it, then I would read and explain. I have explained. Now, when you read it, you should be in a position to understand. Should be in a position to understand. In B Limited's books, initially you will recognize it at 95,000. At the time of settlement, Whatever is the difference, you take it to the P&L. Okay, whatever it is, you will take it to the P&L. Okay, yeah, so that gap of 5,000 here also will be recorded in the P&L. That is also right. Okay, that is correct. That is correct. So the entry will actually flow like this. A Limited, liability 1 lakh, to bank 95K, to P&L 5K. This is actually what will be recorded. B Limited is getting bank account debit 95K to liability 95K. This is based on 109. So you will apply 109 principles, Ind AS 109, and do the accounting. Okay. All right. So this is how it will happen. Okay. So that takes care of the transfer. Is it okay? Have you understood the transfers? All clear? Yes. Okay. All right. So once this is done, we then move on to the next part. How do I look at liabilities or equity instruments of the entity? How do I look at liability or equity instruments of the entity? Okay. Yes, 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 yes. That's right, Sanket. Okay, that's right. But you follow the principles of Ind AS 109. Okay. Yeah. Now coming to fair value rules for liability and own equity. Think about it as broadly categorized into two segments. Your liability is somebody else's asset. Sir, my liability is somebody else's asset. Sir, hoga hi na? Equity which I issue will be another party's investment. Bonds which I issue will be another party's investment. Creditors which I have in my books, somebody will have me as a debtor. So my liability will be somebody else's assets. Will it be always? Answer is no. We may have some liabilities in our books, but there is no corresponding asset. Example, decommissioning liabilities. You have studied Ind AS 16, right? In this batch, have you studied Ind AS 16? Please confirm. Manini, Sanket, Srishti, have you studied Ind AS 16 in this batch? I'm not sure. I think you would have. Not yet studied. Okay. 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 All right. Do you know what is a decommissioning liability? Do you know what is a decommissioning liability? Oh, then I'll have to take it. Okay, fine. कहानी सुनते हैं. Let us listen to a story. Okay. You are taking as per schedule. I'll just increase a little bit. I think you're talking about time, Sanket. Okay, so I will extend by about 15-20 minutes. Okay, up to half an hour max. Okay, so let us listen to a story. Okay, this story is going something like this. Okay, Reliance Industries Limited off Jamnagar coastline. I think Jamnagar is on the coast. So off the Jamnagar coastline, in the middle of the ocean, in the ocean nahi hai wo bhai, Arabian Sea hai. In the middle of Arabian Sea, found oil deposits. बस फिर तेल निकालना है. Wants to extract it. So for extracting, what Reliance will have to do? It will have to construct an oil rig. It will have to construct an oil rig. Okay. All right. Now, when we construct an oil rig, what is going to happen? आ जाएंगे. कौन आएंगे? Environment wale. Okay, these environment people will come and they will say to Mukesh Ambani, if you build an oil rig, the seabed will get damaged. Definitely it will. Definitely it will. Seabed is on the, it's just plain land. The moment you erect an oil rig, you will have to drill holes in the seabed to ensure your oil rig stands. So you are damaging the seabed. And there is a lot of life in the sea also. So you are causing damage to that life. Okay, so the environmentalists will protest. They will say, we will not allow unless you give an assurance that you will restore the seabed, that you will restore the seabed. Okay, so when you restore the seabed, Reliance Industry says, I will need this oil rig for a period of 15 years. 15 years ke baad, I will dismantle the oil rig because Reliance estimates that the oil can be extracted over a period of 15 years. Uske baad oil reserves will get depleted. You will ultimately have no need for the oil rig. So after 15 years, see, Reliance commissions the oil rig. Commissions means installs the oil rig. And after 15 years, it will decommission the oil rig. It will decommissioning the oil rig. So what do you mean by decommission? It will uninstall. Uninstall karne ke baad, you will not only uninstall, you will restore the seabed. Restore the seabed. What do you mean restoration of the seabed? Whatever holes and all you would have drilled, you will make it good so that the life continues in the ocean without any problem. Okay. So after 15 years, uninstall and restore the seabed. Now, this is a promise. This is a promise. A promise means an obligation. An obligation on whom? An obligation on Reliance Industries. When the obligation arises? After 15 years. When the obligation arises, when the obligation will actually take place, it will take place after 15 years. But today, the moment you drill the first hole in the seabed, पहला hole आपने drill किया, you have effectively triggered the liability. You have effectively triggered the liability. So, if the life of the asset is 15 years, if the life of the asset is 15 years, year 0, that means now, year 15. Now, today I have put in the oil rig, which is an asset. At the same time, I will have to recognize a liability today itself, because provision says, what does Ind AS 37 relating to provision says? It says that recognize a liability the moment an event has happened which is triggering a liability for you. So aaj ke tarikh mein I installed the asset, and since I installed the asset, I will have a liability to be paid in the 15th year. So therefore, today only I will recognize that liability. Sir, but liability is to be paid after 15 years. Hanji, you have to recognize it today. That means 15 years worth of discounting has to be done. I will have to discount it to the present value. And that is why today, what will be the entry is, I'm explaining very simple terms. I'm not getting into technical jargon. Asset account debit to bank. This is what you pay for installing the oil rig. To provision for decommissioning, etc. So your cost of asset will be the sum total of both. That means the cost plus the provision for decommissioning, etc. And this will be at the present value. Provision for decommissioning will be at the present value. See why this was done. Earlier, what used to happen was we would not recognize a provision. So immediately in the 15th year, when there would be a decommissioning liability, itna bada expenditure would be debited to the P&L. And then suddenly you would ask, why such a sudden increase in expenditure? And then we would have to explain, no, this was a liability that existed. And secondly, for the first 14 years, you are not booking a liability. That means you are not giving a true and fair view. And that is why you will have to recognize this provision. Then what do you do with this provision? Well, the provision amount, you will go on increasing by the discount. Finance cost account debit to provision for decommissioning. Every year for 15 years, you will do this. At the end of the 15th year, it will come to the full value and then you pay it off. And then the initial amount which went in the cost of asset, this is going to get adjusted by way of depreciation. This is going to get adjusted by way of depreciation. Okay. So this is the broad concept of decommissioning liability. Now, today, now coming back to Ind AS 113. Today, when I recognize the provision for decommissioning, if it is a liability for Reliance Industries, will it be an asset for a counterparty? Will it be an asset for a counterparty? Abhi zara dhyan se. Now coming back to the concept. Tell me one thing. Today I recognize a provision for decommissioning. Do I know to whom I will give the contract for decommissioning in the future? Today, do I know? Have I entered into an agreement with anybody to decommission and restore the site? I haven't. I have only booked the liability. So now tell me, is this liability an asset for somebody? No, it's not. It is a provision. It's not an asset for somebody. So when we come back to our understanding of valuation of a liability, it will be from the perspective of two two scenarios. First scenario, my liability is somebody else's asset. Second scenario is my liability is not yet somebody's asset. Dono ho sakta hai, both can happen. Okay, so like decommissioning liabilities or any provision for expenses. Okay, you can be having this type. Okay, so now when these are held as assets, you can take quoted price of those assets on the market, or you can do a comparable price, or you can do an income approach or market approach. Same. My liability is somebody else's asset. So somebody else's asset means asset ka valuation ke rules kya hai? Quoted price if it is actively traded on the market. If it's not actively traded, comparable debenture, do some adjustments, finish it off. And third one is you can follow any of the other method, a valuation technique such as income or market approach, whatever it is. Okay, so this takes care of the first part. The second part is, if my decommissioning liability or such kind of liabilities are there, it's not somebody's asset, so traded bhi nahi hoga, comparable also will not exist. So you will have to use a valuation technique. Using a valuation technique. Is it okay? Have you understood? Have you understood this part? Yes. Simple concept. Okay. And then the same rules shall continue. The same rules shall continue. Have you understood? Clear? Okay. Kaushiki, Srishti, Sanket, everybody has confirmed. Manini, did you understand? Who else is there? Sumit Jain, Aniket Jain, Soham. Sandhya, Gauri, Balram, Hari, did you guys understand? Okay, great. All right. So this is the way the principle works out. Okay. Assume that what is happening is a transfer, not a settlement. So is there a quoted price? Yes, then use the quoted price. If there is no quoted price, is it held as an asset? If yes, then use fair value of identical asset. If no, then you use a valuation technique and finish off the liability valuation. Okay. Now, when you do the fair valuation of a liability, that liability is also reflecting your non-performance risk. Non-performance risk means credit risk. Credit risk means what? Risk of non-payment of liability. Risk of non-payment of liability. Is it going to be affected? Yes, you will have to record this risk, and this risk will be inbuilt in the fair valuation calculation. Okay, for example, if I have to consider a bond valuation for an entity that is having a triple A rating vis-a-vis an entity that is having a triple B rating, obviously the value for the triple A rated bond will be higher compared to a triple B rated bond, because triple A credit risk is lower, triple B credit risk is higher. Okay. Transfer restrictions, no separate input or adjustment needed. And where the financial liability has a demand feature. Demand feature means on demand you can ask what amount is to be paid. Then discounted from the first date, the amount could be required to be paid. So it's fairly simple. Just read the theory. You should be able to understand. Okay. You can check this example. See, X and Y. X is having a double A credit rating. Y is having a triple B credit rating. So A's credit rating is higher. So Y has a triple B and can borrow at 12%. X will receive 374, whereas Y will receive 284 with a promise to repay 500 in the future. What is the settlement value? Settlement value is 500. आज के तारीख में fair value is going to be 374. So suppose X Limited comes to you and tells, मेरे को पैसा चाहिए, I will pay you 500 later. So you will do a fair valuation and say, based on your credit rating, I can give you 374 rupees today. If Y comes and asks the same thing, I will pay you 500 later, give me some money. You will look at his credit risk profile and then you will say, I will pay you 284 rupees. Sir, why did you pay X more and me less? Because Y ke case mein the credit rating is lower. So risk of default is higher. And therefore we take it as a value of 284. This depends on the discount value that you estimate. This depends on the discount value that you estimate. Okay, so this is simple, should take care of your understanding. Okay. All right. I will leave this question because I would prefer to do another similar question. So I'll keep it for homework. Similar question solved in class. I'll do this now. Okay. Similar question is what I'm going to solve. So you can do this as a homework. Okay. All right. Fine. Then sometimes you would be having a financial asset and liability with offsetting positions. Offsetting means what? You can settle it on a net basis. So you have trade receivables in foreign currency, trade payables in foreign currency. Surprisingly, both of them are getting settled on the same date. So therefore, you can enter into a forward contract with the bank to buy the net amount. in case the payment amount is higher, or sell the same amount in case the receivable amount is higher. And you can do a fair valuation of the net amount that you are going to sell or the net amount that you are going to receive. Is it mandatory? No, it is a choice. So you can either choose to show full value of assets, full value of liability, do a complete fair valuation, or what you can do is on a net basis, you can perform a fair valuation. You can perform a fair valuation. Okay. So that takes care of this part also. You can read this theory, nothing difficult or different. Okay. And now coming back to what was Srishti's, I think, question in the last class. Okay. So far, is it okay? So far, is it okay? Yes. I'll come to the liability valuation. Okay, what I'll do is we'll discuss this last. Okay. All right. Okay. All right. So this takes care. This takes care. Okay. I have a query from Srishti. Okay. So this is what she has asked. Market risk should be the same while combining any asset and liability. Okay. An interest rate risk cannot be netted off with a commodity price risk. Okay. So suppose you are having, this is offsetting, no? Yeah. Okay. So your liability is becoming due on 31st Jan 2022. This liability on 31st March kar lete. Okay. This is resulting in a trade receivable from your creditors towards goods which you have sold of $1,000. On the same date, a loan is repayable of $1,200. Now, trade receivable is a financial asset. You have to go for fair valuation. Loan payable is a financial liability. You have to go for fair valuation. Suppose you say that I will do a valuation on net basis. I will do a valuation on net basis. You have to look at how the inflows and outflows of these two instruments pan out against each other. In this case, trade receivable is related to a commodity. Trade receivable is related to a commodity. So this is subjected to a commodity price risk. Tomorrow, the trade receivables can fluctuate depending on how the commodity market in which you're dealing with fluctuates. Whereas the loan payable will depend on how the interest rates fluctuate. How the interest rates fluctuate. You cannot net off the goods, the trade receivable against the loan payable and say that I will do a fair valuation of net payable of $200. No, you will take it as 1,000 for trade receivable. You will take it as 1,200 for loan payable and record them at full values. Why? Because the risk profile of the trade receivable is based on the commodity exchange, whereas in respect of the loan payable, it is based on the currency markets, and therefore the risk profile is totally different, and that is why you cannot net it off. So that is the meaning of market risk should be the same. Market risk should be the same. Is it okay? Have you understood this? Yes. Srishti, did you follow? So you cannot net it off. That is what I want to tell. Okay. All right. Okay, fair enough. Now we move on to one example. Okay, we move on to one example, and then we shall come back to the last part, that is initial recognition. Okay, I'll come to the second part of the question, then we move on to the first part. Okay, Rohini Limited acquired an entity on 31st March 20x2 and is required to fair value a decommissioning liability. So the entity had a decommissioning liability, it has to fair value it. The entity has to decommission a mine at the end of its useful life, which is in 3 years' time. So the liability is to be paid in 3 years. Rohini has determined that it will use a valuation technique. कोई और option भी नहीं है. If Rohini is allowed to transfer the liability to another market participant, the following data would be used. Labor and material cost 14 crores if this is transferred to somebody. Overheads 30% of labor and material. Third party markup industry average is 20%. Risk of non-performance is 2%. Inflation rate annually 5%. Risk adjustment cash flow uncertainty 6%, and risk-free rate of government bonds is 4%. How should Rohini Limited measure the fair value of the above asset and liability under Ind AS 113? Okay. So just go through this, then we will see at how the question is getting solved. Just go through this once. I have a bad cold. Did you go through the question? Yes. I know most of it you may not be able to comprehend, like the rates and all. We will understand them one by one. Have you read it? Yes. Okay, so let us then proceed further. Okay, see, understand now. A mine has to be decommissioned. For decommissioning that mine, material cost, material lagega. I will have to restore the place to its original environmental way. Yes. Material labor के साथ you will also have overheads. You will also have overheads. Now, it is what is fair value? Price paid to transfer a liability. So if I have to transfer this liability from my head to somebody else's head, that somebody else will say, why should I do your job on free? Yes or no? वो बोलेगा, why should I do the job for you without any benefit for me? You give me some benefit, then I will accept your liability. That something is known as third party markup. That something is known as third party markup. Okay, so that is the profit margin which the transferer, I think, the transferer, okay. Not the transferer, the transferee, okay. The recipient of the liability is who is getting the liability. He will demand a markup, a profit markup. Then there is also a risk of non-performance, that the decommissioning may not happen. What is annual inflation? Well, you have estimated the prices today, but the decommissioning will happen after 3 years. So every year there will be an inflation, right? So that is the inflation rate. Then there is a cash flow uncertainty risk adjustment. What do you mean by this? Well, this means that my cash flows are uncertain. This is just some approximate figures which I have considered, but this is a provision for contingency. That means I will add this markup to my cash flows to ensure that it meets any small increase, decrease that may happen in the future. And risk-free rate of government bonds, all of us know. So now the question is, how do I value these bonds? Okay. Sorry, this decommissioning liability. Okay. So first is labor and material cost, 14 crores that you have to pay. Overheads 4 crore 20 lakhs, 30% of that. So 18 crore 20 lakhs. Okay. 18 crore 20 lakhs. Now, because you transfer this to a third party, the third party will say, "Main tera kaam kyun karu? Why should I do your job? You give me something that benefits me, then I will do the job for you." So then the industry on an average is asking for 20%. So you will add 18.2 crores into 20%. That is 3 crore 64 lakhs. So this makes 21 crore 84 lakhs. This is in today's terms. Today's terms. Price in today's terms. Okay. Now, I have determined the liability today, but when will the settlement happen? Sir, the settlement will happen after 3 years. 3 years may labor costs will increase, material cost will increase, overheads will increase. Kuch to increase hoga. That something is given as 5% per annum. Is given as 5% per annum. Inflation rate. This is like the opposite of growth rate. Growth rate, we would consider the growth in our sales, etc. This is inflation. Because of this, my costs start to increase. So 21.84 crores into 1.05 raised to 3. 1.05 raised to 3. And therefore, each year it goes on increasing. Okay. So therefore, at the end of the third year, this would be 25 crore 28 lakhs 25,200. But still, by today, this is just an estimate. In the future, kitna material lagega? How many laborers would be needed? Any technology changes that would happen? Finally, will this work be done or not? All these risks will be there. So the value of that risk is 6%. Value of that risk is 6%. So the contingency that I have kept is 1 crore 51 lakh 69,000. So therefore, this is price in future after adjusting uncertainty. After adjusting uncertainty, 26.79 crores. Now, this is the price after 3 years. So you will have to bring it to the present value. So 4%, this is risk-free rate. 2% is risk of non-performance, yani our risk. Okay. So this divided by 1.06 raised to 3 gives you 22.5 crores. 22.5 crores. Have you understood this solution? Yes. Fairly simple. Okay. Fairly simple. Did you follow this? Yes. Kaushiki, Srishti, did you follow? Kaushiki, okay. See, when is this liability? Last step means I take it that you're talking about discount rate. Okay. This is price after 3 years. Okay. This is price after 3 years. So you have to fair value today. No, measurement date is today. So I will have to discount it. What rate will I discount? Can I discount it at the risk-free rate only? No. You have to consider the risk that the entity may not fulfill the obligation. You have to consider that risk also. That risk is 2%. So what is your total risk? 6%. Your total risk is 6%. Your total risk is 6%. And therefore, from there, you will have to discount it. So 26.79 crores into 1 divided by 1.06 raised to 3. 1.06 raised to 3. So that comes to 22 crore 50 lakhs. Did you understand, Srishti? Yes, all clear? Okay. And now we look at that small question which Institute has asked. It's the same. So I'll just show you. See, A assumes a decommissioning. हमारे में रोहिणी था. If A was contractually allowed, it concludes that a market participant would use all the following inputs. So labor cost is given. This is the only change which has happened, but it's not a great change. Okay. Labor cost, what they are telling, it is based on current कहानी बताया है. Adjustment, adjusted for expectations, etc., etc. Assigns a probability to a range of cash flows. So what you will have to do, 100 into 25%, 25. 125 into 50%, 62.5. Weighted average plus 175 into 25, 43.75. So bus go on adding plus 62.5 plus 25. So this comes to 131.25 crores. This is your expected value. Expected value. Okay. 131.25. Labor is done. Overhead is 80% of labor. So you got it. Compensation includes both of the following. Okay. Profit on labor and overheads 20%. Risk that actual cash flows might differ. That is cash flow uncertainty. 5% of expected cash flows. Effect of inflation 4% over the 10-year period. Risk-free rate is 5%. Non-performance risk is 3.5%. So all the things are same like we did in our question. It's just that here the data is slightly different. Otherwise, it is the same. So A Limited concludes that these assumptions would be used by market participants. Additionally, does not adjust fair value measurement for the existence of a restriction. You are required to calculate the asset retirement obligations fair value. Okay. So is it done? Yes. Are you convinced that this question is similar? Yes. Manini has confirmed. Okay. All right. So that takes care of that part. Coming to last concept, fair value at initial recognition. Okay. All right. Now see, yesterday's query, I have parked it for today because it's a very small concept. fair value, bol ke thak gaya. It is an exit price. It is an exit price. It is an exit price. If it is an exit price for you, it will be an entry price for the opposite party. Yes, definitely. It will be an entry price for the opposite party. So in normal transactions, the exit price for somebody is equal to the entry price for somebody is equal to fair value. So normal cases, fair value is equal to exit price is equal to entry price normally. Okay. So whenever I discussed exit price, it will be the entry price for the opposite party. It will be the entry price for the opposite party. But there are four exceptions to this rule. There are four exceptions to this rule. The first one is transaction between related parties. When I say transaction between related parties, there is always a suspicion that the transaction might not have happened at fair value, So there is a chance that the entry price is different from the fair value. The entry price is different from the fair value. Additionally, the second condition is if the sale is happened as a forced sale or under duress. If it is a stressed situation, then it will not result in exit price being equal to an entry price. Okay. Like for example, an entity is going, what you can say, does not have cash to meet its obligations. It needs to sell off its assets in the next forthcoming year. So as on 31st March, if you have to do the valuation, this is under stress. Market knows that you are selling under duress and therefore it will try to exploit it. So therefore, that will not be regarded as fair value for that purposes. Entry price won't be equal to the fair value. The third case is something known as unit of account. Okay. We will discuss this one concept we had not discussed. I had parked it for this reason. Unit of account. What do you mean by unit of account? Unit of account essentially means what is the base which you are using for measurement? What is the base which you are using for measurement? Sir, matlab, example. Fair value of equity shares of Maruti is equal to price of one share on NSE. So what is my unit of account? Equity share. So the unit of account is the basis of measurement. My unit of account in this case will be per share value on the stock exchange. Another example. Fair value of 1 gram 50 grams of 24 karat gold is equal to price of 1 gram multiplied by 50. So what is going to be your unit of account? Grams. What is going to be your unit of account? 1 gram. इसको हम लोग बोलते हैं unit of account. Sir, can it be different? Yes. For example, fair value of division. Fair value of division is equal to fair value of assets together. Individually, the fair value could be different, but when they clubbed or join hands together, then that point of time the fair value are going to be different. Sir, ऐसा कैसे हो सकता है? Division की अगर बात करेंगे, then all individual assets together should be the value of the division. Not necessarily. Suppose if you take a hotel industry, kitchen utensils, क्या value रहेगा उसका? What will be the value? Okay, वो use करते they are quite worn out always. Okay, but when you value the kitchen of the hotel or when you value the hotel itself, that time If the kitchen has a very high rating, then the value of that hotel itself will go up. The value of that hotel itself will go up. And therefore, you cannot say that fair value of a division is equal to the sum of the fair values of the individual assets and liabilities. वो नहीं बोल सकते आप. Yes, because as on the date of valuation, the two things are totally different. You are valuating the division as a whole, whereas another entity is valuing based on individual assets and liabilities forming part of the division. So the unit of account is going to be different for both of them. Okay, so therefore here the unit of account is different. Okay, assets not here, sorry, fair value of assets together, which is not equal to fair value of individual assets, liabilities. Okay, fair value of assets together, that will be your unit of account. The division will be your unit of account. In the first case, 1 share is your unit of account. In the second case, 1 gram is your unit of account. Have you understood this? Yes. Have you understood this unit of account? Unit of account समझा भाई अपने को? बोलो. Have you understood unit of account? Yes. Okay. So now it may happen that A Limited sells some assets as a slump sale. The value of all those assets put together is say rupees 100. Okay. Now, in example 3, it will be the division. The unit of account will be the division, which is what I'm explaining now in the example. There is a slump sale. It has sold 2 assets put together. Okay, 2 assets. I'm taking it very simple. It has put 2 assets sold together. So therefore, the slump sale will be rupees 100 for the group of assets transferred. However, it has sold it to B Limited. The recipient entity is getting the goods, the assets. It is getting 2 assets, asset 1, asset 2. It cannot record it together because in the books you will have to attribute a value to both of them, right? You will have to attribute a value. For B Limited, the unit of account is going to be individual assets. Unit of account is going to be individual assets. And then it recognizes the value. Let us assume this is 45 and it recognized this as 50. The slump sale value was 100. The fair value which you have determined is 95. This is an exit price for A Limited and entry price for B Limited. There is still a gap of rupees 5. This 5 is on account of different units of account for the transferor and the transferee. Okay, have you understood this? Yes. Have you understood this? Yes. Sir, what to do with this difference of rupees 5? I'll come to that later. But as of now, have you understood that the prices can be different? Yes. Understood? Okay, fine. So now it will not be equal in case of different units of account. And finally, it may not be equal if the transaction has not taken place on the principal or the most advantageous market, on the principal or the most advantageous market. Okay, so if all these things are there, then at that point of time, what will happen is there is a difference in the pricing. Fair value is something else, booked value is something else. So the difference will go as day one profit or loss on initial recognition. You will recognize it in the P&L if it cannot be attributed to transaction costs. If you cannot attribute it to transaction cost, that means what happens in this case, this 5 rupees, I paid 100, I got asset worth 95. That 5 rupees is going to go as a day one loss in your profit and loss account, because you paid more, you paid 100 and got assets worth 95 only. So 5 rupees you have paid extra. So that gives you a loss. Is it okay? Is it okay? Yes. Have you understood? Anywhere there is a difference on initial recognition between the fair value and the transaction price, then that difference will be taken to the profit and loss account as profit or loss on initial recognition. Profit or loss on initial recognition. So to sum it up, unit of account we discussed entry price, exit price, and we discussed fair valuation of liabilities and equity. This one, please solve after Ind AS 41. I believe next week you may be having Ind AS 41. Just check your schedule. So now I want you guys to solve this after Ind AS 41. Then you can appreciate the profit or loss arising on initial recognition. Okay. Today I cannot do it because you have not yet gone through Ind AS 41. Okay. And this last question, I'll be leaving it for you. The first part of the question. Okay. The first part. It's quite simple, nothing great. Okay. You have 3 markets. You have to identify which is what is the fair value. Okay. Identify what is the fair value. I'll share this with you. Okay. All right. So with that, I think we conclude the discussion. Any doubts? Final set? Any doubts, queries, comments, improvements needed from my side? Speed is okay. Pace is okay. Queries are solved. Queries are unsolved. What is there? Okay. Before we sign off, one thing, go through the homework, whatever I have given today or tomorrow. Try to revise the sessions the same day. Second, tomorrow onwards, we are commencing Ind AS 116. We are commencing Ind AS 116, that is dealing with leases. Okay. Now, I have been told by the institute that this 3 sessions will largely be a problem solving session. Okay. I think even Ind AS 115, Alok Garg sir has discussed in a similar manner. I'll need your inputs. So Ind AS 116 will largely be a problem solving class. I will not be discussing theory in great detail the way I did for 113. Because if I go for discussing theory of Ind AS 116, it will take me 2 to 2.5 classes. And that is going to be massive. Okay, I have 3 classes where I would like to do the problems with you. Okay, so my advice, I had taken 116 in the previous batch. Please go through that. The theory is explained reasonably well, okay, in that class. Or Alok Garg sir also had taken 116. So I think he is he's an authority on 116. So go through the theory aspects in those classes, my class or sir's class. Tomorrow, I will start with problem solving, but I will definitely give theory related to that problem as a discussion. But going down to the bare basics and discussing the theory won't be possible because of lack of time. Okay, so try to go through these sessions today if possible. I know it's a heavy ask. Try to do it, and then we will see how to work out the solutions. Okay, we'll work out mainly on the solutions. Okay, question solving and solutions. So see you guys tomorrow. That's it for today. We will meet tomorrow, Tuesday, Thursday. We should conclude 116. Okay, so thank you everyone. See you tomorrow. Have a nice day. Thank you.